just to set the record straight, I'm actually a senior manager. Some of my partners are here, so maybe one day. But good morning to you all. I'm here to tell you a horror story. This isn't your typical horror story. It involves good intentions between a father and his children that our friends or foes at the Canada Revenue Agency, or CRA for short, didn't like. And like any horror story, someone gets killed. But don't worry, it's only financially killed. This is a story about the Jacobs, a nice middle-class family who run a successful family business. Bob Jacobs, the father, has operated a second-generation restaurant supply business, which was passed down to him from his father when Bob was in his mid-30s. Bob has successfully operated the business now for about 25 years, and he has been able to provide himself a comfortable living for himself, his wife Mary, and his 2 children. Our story begins with Bob turning 60, and as he reflected on this milestone birthday, he began to realize that he wanted to start spending less time at the office and focus on some of his other passions in life: golf, cooking, travel. Bob decided that now was the right time to transition his family business to his 2 kids, Jillian and Mark. Jillian is 35, she's been married to a fine gentleman for 7 years, and she has 2 kids of her own. Mark is 32 and has just introduced his parents to his newest girlfriend, or the flavor of the month as his parents call her. Jillian and Mark have both worked in the family business since their graduation, and they have both helped contribute to the continued success of the family business. Obviously, they were a natural choice for Bob to continue the family heritage. As Bob began to think about his retirement more seriously, he started to get very excited about the opportunities available to him in his retirement. He quickly decided to transfer his shares of the business to his kids in the form of a gift. He knew his kids probably wouldn't have enough money to actually buy the business from him, but this was his way of realizing his dreams of having his children carry on the family legacy that his father had continued. Bob couldn't have been prouder. Bob immediately went off and started down his happy path of retirement, unaware of what lurked ahead. Remember, I did say this was a horror story. One day, after returning home with his wife from a gourmet cooking class, Bob checked the mail. He was completely shocked to see he had received a nasty letter from the CRA asking for tax on the sale of his business. Bob didn't understand why. Why would he have received such a letter? Obviously, the friends of the Canada Revenue Agency must be mistaken. He didn't sell the shares. He gifted them to his kids. Surely, he figured, once he explained this to the CRA, they would correct their records and leave him alone. What Bob didn't realize is that the CRA was in fact correct. You see, whenever we give something of value to our children, the CRA considers us to have sold it for fair market value, even though we don't get anything in return. It doesn't seem fair, but it is the law. So in the eyes of the CRA, Bob had actually sold his business to his kids for this fair market value. And the difference between the determined fair market value and Bob's cost, which was negligible, is considered to be a capital gain. And the CRA wants their tax on this capital gain, and they want it now. Bob would now have to pay tax on this gain. And remember, because Bob simply gave away his shares of the business to his kids, he hadn't factored in the large cash outlay when he was determining how much money he was going to have to need to live off of retirement. He simply now wouldn't have enough money available to him to cover this tax bill, as well as maintain the lifestyle he'd envisioned in the future. This is the scariest part of the story. So how do we change our horror story and turn it into a fairy tale with a happy ending? Everybody likes a happy ending. The important question is, what did Bob do wrong, and what should he have done differently? Well, the answer, as I'm sure you're aware, is many different things. First off, as we know, succession planning doesn't start when you retire. It should start well before then. 2 of the key ingredients in a successful succession plan are vision and foresight. There are several ways that Bob could have lessened and or delayed or deferred his tax bill. First, we need to consider ways to help Bob reduce the tax bill that he faces, and then we're going to think about some options again to help delay or defer or push this tax bill off into the future. Some of you may be familiar with a phrase referred to as the capital gains exemption. Does it sound familiar? Well, while most of you are not fond of the CRA, myself included, this is actually one of the nicer gifts that they've given to us to help to reduce tax on a capital gain when we sell or give away shares of our businesses. But while it is available to us, you actually need to tell the CRA that you want to use it. They don't just automatically give it to you. So while this was potentially available to Bob as a result of the gift of the business to his kids, he needs to ask for it. Now, of course, I'm not going to go into all of the fine print detail that comes along with this gift. It does get very complicated. But what this exemption does is it potentially allows Bob to realize up to $750,000 of a capital gain on a tax-free basis. So if Bob knew about this, and if his company qualified, he would have been able to actually reduce his tax bill that arose as a result of the gift. Again, as I mentioned, there are many detailed rules that go into determining if you qualify, but please, as a business owner, do yourself a favor. If you're considering this strategy, determine if you fit into these rules and you qualify for the exemption. Another way that Bob might have been able to help his cause would again have been to delay or defer tax into the future. Using what is called a reserve, Bob may have been able to pay tax on the capital gain over a period of time. This reserve is possible when you receive a capital gain on the sale, but you actually don't receive the funds for the transaction at the time of the sale. And in this case, because Bob actually gifted the shares of his business to his kids, specifically to his kids, he may be able to extend the period of recognition of the tax over an even longer period of time, up to 10 years. If Bob's gift fit into these rules, Bob may be able to pay as little as 10% of the tax due as a result of the gift over each year for a period of 10 years, as opposed to paying 100% of the tax today. Again, the extension arises because he was passing down the business to his children. There's specific circumstances, but because the children are the recipients is the key here. Again, what Bob didn't consider when he gifted the shares to his kids was that he wasn't going to receive any money from his kids on the transfer of the family business. So before pulling the trigger on this type of transaction, Bob should have given a long, hard thought to two things. One, did he have enough money to actually pay the capital gains tax on the sale? And two, was he going to have enough funds to last his and his wife's lifetime, while also considering their lifestyle choices and, of course, factoring the effects of inflation? Bob and any business owner would never intend to put themselves in a situation where they would run out of money in their lifetime and then have to turn back to their kids and ask for financial support. Maybe that's the scariest part of the story. After learning about these unanticipated tax results that Bob faced as a result of the gift, he started to wonder maybe he would have been better off if he actually sold the business to his kids for fair value. Would he be in a different tax position? Of course, the problem with this, or the issue with this, is that the kids would actually have to come up with the cash to buy the business. But if we assume that the kids had the funds or they're able to borrow money to buy the business, would Bob have been in a bit different tax position? Again, under a sale of the business to his kids, the income taxes on the capital gain would again have been due immediately, but at least this time, Bob might have the funds available to actually pay the tax. Again, the $750,000 capital gains exemption that we discussed earlier may again be available to Bob under the sale plan, as it possibly was under the gifting plan, which obviously would be very useful. And again, if the kids were going to pay Bob for their shares over time, that deferral or delayed payment of tax over 10 years may again be possible, as opposed to paying all of the tax upfront today. An important consideration is that when working out the terms of the sale option, there is flexibility to allow the timing of the payments to work both for Bob as well as that of his children. And again, while the tax results of a sale of the business to his kids versus a gift of the business to his kids may not be that different, at least under a sale transaction, as I mentioned, Bob would actually have some cash to pay his taxes and fund his retirement. Now, because of that, Bob obviously would have been better off selling the business to his kids, but there is another option that would provide an even better scenario for Bob. There's another method that Bob could have used to transition his family business that would have allowed him to do so in a tax-friendly manner while still providing him with capital to fund his retirement. And this method is commonly referred to as an estate freeze. You might ask, what's an estate freeze? Well, an estate freeze is it's just a fancy tax maneuver whereby a business owner, such as Bob, transfers the future growth of the business to the next generation without paying any immediate tax at the time of the transfer. In very general terms, Bob would freeze the value of the shares in the business that he owns today at today's fair market value, and he would restructure the ownership of the business such that he would allow for the future growth to accrue to his kids. Again, it can be a complex transaction, as all things in tax are, but there are different ways to structure and implement an estate freeze. The variables, of course, being what Bob's different objectives are. In its simplest form, Bob would simply trade the shares that he currently owns for what are called freeze value shares. These frozen shares that Bob receives will never increase in value, and God willing, if the children learn how to run the business successfully into the next generation, the frozen shares should also never decrease in value. As long as these frozen value shares are in existence, Bob will have a right to that value. Bob's kids would then come along and subscribe for a nominal amount for the new growth shares of the business. There are so many positive aspects of this type of estate freeze transaction. First of all, the kids would only have to come up with a very small amount of cash to fund their interest in the growth shares of the business. The reason being that all of the value in the business up to this point in time is now trapped or capped in these frozen value shares that Bob, as the former business owner, would have. This, of course, will help Bob achieve his objective of having the kids come in for ownership of the business without having to cough up a lot of money to buy him out and pay him at the time of the transaction. Second, Bob will continue to hold the value of the business in his frozen shares, and he will ultimately be able to provide himself with the capital necessary to fund his retirement as a result of the capital in those shares. Third, we've heard this before, but again, as it is often said, there are only two certainties in life, death and taxes. An estate freeze can help you delay taxes, unfortunately not death. Bob now will be able to estimate the amount of tax that he will pay on death as a result of this estate freeze because his value in the business will be frozen at today's value. It now provides him with the opportunity to plan for this future tax event, either by setting aside the appropriate amount of cash to cover the tax, or perhaps by purchasing a life insurance policy that will pay out to cover the tax on death. Fourth, there's actually a way, too, that Bob can reduce the amount of tax that he would have to pay on death. As I mentioned, Bob has capped his future death tax liability by freezing the value that he owns in the family business today. Bob could then use these frozen shares to fund his retirement. Perhaps he was planning on paying out cash dividends to himself every year on these frozen shares. Now, instead of paying out those cash dividends, Bob could in turn begin to redeem out the value of the capital in those shares over time. The tax consequences of the share redemption versus the cash dividends received would be the same. The benefit being that if Bob was able to fully redeem himself out over his lifetime, there perhaps would not be tax on death, as those shares would not be in existence at the time. There are many different ways for Bob to go about an estate freeze. For today, I recognize that I've only considered a very simplistic, yet, in my humble opinion, effective example. If Bob did have other objectives that he wanted to achieve, the plan would simply be adjusted to meet those needs. In this story, Bob ran and operated an active operating business, but it is important to point out that this type of estate freeze can also be useful in that of an investment business or other passive type of business. So what have we learned from our discussion? Number one, succession is not something that you plan at the time of your retirement. You need vision and foresight to create an effective, great plan. Number two, if Bob's succession plan had been properly implemented at an earlier time, Bob could have maintained control of the company while setting up a smooth transition of the business to his kids on his timetable. And number three, if you're not careful in your succession strategy, you can be blindsided by unexpected costs and consequences, as we have seen today with Bob in the example of the impact of taxes. So in summary, you need to consider various alternatives to transfer your business. Each method will have its own unique pros and cons that need to be tailored to your own individual circumstances. But clearly, the use of a very carefully thought out and well implemented and properly maintained estate freeze should help you achieve some of these objectives. Now remember, you don't want to be the subject of our next horror story. Thank you.